Okay, so what I have to say is too little. I usually have little to say. This is because these things that I want to talk about, you already know them. But it's okay, whether we know them already, we can still discuss. We want you to participate fully so that we cannot talk about the same things alone again and again. Question number 1A reads, define the following terminologies. Money. What is money? Anyone to pick this one? May people participate and answer these questions themselves. What is money? Hello? Anyone to answer this one? What is money? We don't know what money is. We have forgotten what. Yes, sir. What is money?
It's a medium of exchange.
Wow. How would you write that in an exam? That is all? Is that all?
Not really, no. It's also act as a. It acts as what is that? It's a medium of exchange. Can you define it as the function or what?
Yeah. Yeah, you can still define it as a, from the functions point of view.
Okay, it says status of value. It can also be used as a credit. What if you want to get something on credit? Yeah, I think those three. I've forgotten the last one.
All right. So money, what is money? Do we have some more definitions? What is money? How would you define money? Okay, so you would say that money is anything of value, of course, that can be used as a medium of exchange. Medium of exchange. It can be used as the store of value. The store of value can be used as the unit of accounting, right? And it can be used to make deferred payments. Wow. So in short, last time I said that whenever we are defining money, we define money in terms of its functions. We may not really give only one definition. So usually the researchers have concluded that the way how we define money should be defined in terms of the functions thereof. Okay, so you can just say anything of value that is a medium of exchange, the store of value, the unit of accounting, and that is used to make the deferred payment. That is money. Okay, anything of such nature. For money to be called money, it has to meet at least all these functions. Then that's when we can say that money is money. All right. Sometimes there is that question that we read, for example, in the previous study, where we were asked also to mention some properties. Is it characteristics of money? What are some of the characteristics or properties of money? Characteristics. We are just studying and revising. That's why we are including all such. Characteristics of money. What are some of the characteristics of money? Hello? We can say there are many of them. You can just pick one and say one. What are the characteristics or the properties of money?
I think some of them are the one that you have been talking about: the medium of exchange, unit of account, store value, standard deferred payment. Is it not the same?
Those are the functions of money, but what are the characteristics or the properties of money? Very important. What are some of the properties?
It is.
Yes, you can go ahead. It is what?
Purchasing power.
Purchasing power. Okay, so money can be used. Is purchasing power. What do you mean? I like asking such nice questions. Oh, you shed more light. All right. Okay. Trying to remind the class. So we said that money has the following characteristics. Number one, it is divisible, right? Money is divisible. You can break it down into small units. Money is what? I've reminded you now. You can break down money into small units. Money is portable.
Okay.
What else?
Durability.
Yes, money is durable. What else? Money is widely acceptable. There is nowhere where they will refuse it. And the money is what? Money is scarce, scarcity of money. Okay, so these are some of the characteristics or properties of money. We have many of them anyways. Yeah. What about a credit multiplier? What is a credit multiplier? By the way, the credit multiplier is also called money multiplier. What is money multiplier? What would you write in case next month you have such a question? What would you say?
So to me, I can say it's a money. Let's say when the bank receives the credit, it's a money that is used, the percentage that is used to multiply the money by crediting other account. The fraction actually.
Okay, thank you very much for that one. Do you have any other definition of credit multiplier? So a credit multiplier is a coefficient, okay, it's a coefficient or the money by which by which the deposits in the money creation process can increase or can be multiplied. So that coefficient, that amount by which the deposits, those that you deposit, of course, that participate in the money creation process, the deposit, the coefficient by which money can increase is called the money multiplier. All right. We have the question again. It says, give a detailed account on how the Bank of Zambia Central Bank can increase money supply by using the monetary policy. How does the Bank of Zambia increase? You are giving a detailed explanation or detailed account. Anyone? Okay, maybe let me lay a foundation for you so that you don't waste much time. So remember, the Bank of Zambia, or the central bank, uses 3 tools in controlling money supply, and these include the open market operations (OMO). These also include the discount rates, and they also include reserve requirement ratio, the reserve requirement ratio. So how can the central bank use these tools to increase money supply? I've tried to narrow the question a bit. Any explanation? You can pick one of the tools and explain how it is used. There are these 3 main tools.
It was looking simple, now it's becoming difficult.
Interesting. Yeah, it is becoming difficult again.
So discount rate?
Yes.
So the Bank of Zambia will reduce the discount rates so
Yes.
that more firms can go and borrow the money. In the end, there will be more circulations in the economy.
Okay, thank you very much. Maybe you should just remove the word firms.
Okay.
Because it is not the firms borrowing from the central bank. So when the discount rate has been reduced by the central bank, it is the commercial banks that go to borrow from yes. So we can replace that by that. Thank you very much. Do we have any other explanation on or an addendum to this, or an explanation on a different tool? The tools that the central bank uses to increase money supply. Just an addition on the discount rate. So what happens, the discount rate by definition, it is the interest rate that the central bank charges commercial banks, okay, when they borrow, okay? When the commercial banks are borrowing money from the central bank, or when they want to get the loans, there is that interest rate that the central bank charges. It is called the discount rate. So if the central bank reduces the discount rate, what happens is that the commercial banks will find it cheaper to go and borrow money from the central bank, and later on that money will be given as loanable amounts. The commercial banks will give loans to the firms and to individuals. Therefore, we will have a lot of money in circulation. Is that clear? Hello.
Yes,
is that clear? Okay. Then what about the other two? You can pick another two.
hello, sir.
Yes, sir.
Okay, just to explain a bit or to try on the reserve ratio. So by definition, we define the reserve ratio as the fraction of deposits that banks hold as reserve. So when from the reserves, when a bank makes a loan, there will be money in circulation, is it? So the money supply will increase. So by having that increase in money supply, it's, I think, also a way in which the Bank of Zambia can increase, money supply. So okay. Something similar to that.
Okay, thank you very much for that one. Do we have any addendum on the reserve required ratio? The reserve requirement ratio?
Just to try some. So this is when the central bank will reduce the reserve ratio to allow more circulation in the economy.
Thank you very much. So just to add on the same, what the two speakers have already said. So usually the reserve requirement ratio is set by the central bank, ordering the commercial banks to ensure that for every deposit, they should be keeping a given fraction. So if they increase the reserve ratio, it means the central bank is encouraging the commercial banks to have a lot of money that they keep as reserves, not allowing to go into circulation. But if the reserve required ratio is reduced, we'll have more money going into circulation as the loanable amounts. So therefore, that would be one of the ways on how central bank will increase money supply. Is that clear?
Oh, yes, sir. Yes, sir. Yes.
Okay. Anyone to comment on operation or market operation? Open market operation, OMO. What about the open market operations? All right. So with the open market operations, OMO, this is where the commercial, the central bank sells or buys the bonds and the treasury bills. They buy the assets or sell those assets, the paper assets, to the public. So when they want to increase money supply, what they do is that they buy the bonds and the treasury bills from the people who hold them. So they buy more of the bonds from the people. They buy the bonds so that they give money to those people by buying bonds. Then if they want to reduce money supplies, I think I should be hitting both sides of the. If they want to reduce money supply, they can sell the bonds, right? When they sell the bonds, what will happen is that people will get the money that they already have in the circulation and take it to the central bank by buying the bonds. So basically, that is how the open market operations works. So the discount rate, if they want to reduce money supply, they can just increase it. And similarly, the reserve requirement ratio, if they want to reduce money supply, they can still increase it. Riding on the same explanation that we have given. Any question?
On almost,
Yes, sir.
when the government buying those bonds from the people, do they buy at a maturity rate or what? With interest. Let's say you are supposed to get in the next 2 years, you are supposed to get 2,000, but it is on 1 year and when they calculate, maybe it's around 1,000. Do they buy it at the rate of the maturity or just from the where it is?
Oh, okay. Oh, I get the amount, the question. So to start with, the whole idea of buying the bonds is that we give you what? We give you money. So usually it depends. Sometimes they can buy it at maturity level, but usually they buy at maturity level, like that value, so that they just supply. Because when you buy the bond, you hold the bond, there is that locked amount that you're going to have, okay, that you are sure that you're going to buy. So usually they buy at maturity level of those bonds, especially those that are within 7 years and down, okay, 7 years and down. However, sometimes there can be calculations that can be done to see the prevailing rate of the interest, to recalculate. For example, for those bonds that whose life is too long, okay, there are those bonds that are whose life is really long, many years. So for those bonds, usually it is recalculated so that the government does not make loss again. Very important. Did you get it?
Yes, sir.
Okay. Question number C reads, assume that the Bank of Zambia sets the reserve requirement ratio 15% and the initial deposit in the Zambian economy is 1,200 kwacha. Can you calculate the credit multiplier? So the credit multiplier is calculated by saying that 1 over the requirement reserve ratio, okay? That is a credit multiplier or money multiplier, if you want to call it that way. So you say 1 divided by what? 15%, which is 0.15, okay? So what is the money multiplier or the credit multiplier? What is the credit multiplier?
6.6667.
6.667.
That's a multiplier.
Okay.
Then you multiply it with 1,200.
Okay. So no, the question is asking about credit multiplier. First, we just want the multiplier.
Oh, okay. Yeah. 6.7.
Okay. So 6.7. So how much money will initially be available to be given as loans? So you need to calculate now the 15% of this, of the initial deposit. So from this initial deposit, just as we were saying, they have to keep 15%. So 15% of 1,200 is how much?
It's 180.
Sorry, 180?
Watch.
Okay. So this 180 kwacha will be the reserve requirement, okay? So this amount will be kept by the commercial bank. It will not be sent into circulation. Then the rest of the money will be given as the loanable amount. So you say 1,200, the total deposit minus the reserve, okay? What remains the loanable amount? And how much is the loanable amount?
It's 1,020 kwacha.
1,020 kwacha, or 1,020 kwacha. So like this sentence. All right. Any question? Is there any question? Okay. Then we can go ahead and answer the next question. How much will be kept as reserves? We have already answered this question, isn't it? How much will be kept as reserves?
180.
108 now. How much will the deposit be in the Zambian banking system by the end of the credit creation process? So it means, again, you repeat this 180, how much was it? The loan amount. Was
1020.
the
1020.
1020. Again, you do 15% of that. Then what will remain is the reserve, because it's a deposit again. So again, the other money that you remain with is another another amount that you will be loanable. So this excess deposit. Okay, calculate what is the 15% of this first, that you understand properly.
153.
153. So this 153 is called the reserves. So now this 153 shall be added to the other amount that we had left. It was how much? 180, right? That was the initial required reserve. So when you add 153, this 153 is called the excess what? Excess reserve. Okay? Because the business, what is this? The bank is just supposed to hold the 180. So this other 150 will be called the excess reserve. The excess reserves, again, will be added to the loanable amount. Okay? It will be added again to the loanable amount. It will not be kept by the bank. So that, again, the credit creation process continues. So the excess reserve shall be added to the initial amount. It will be more like, again, the deposit. Did you get it?
Oh, come again on that one.
Okay.
So you're saying the
153
will be added to 1,200.
The 153 that we have, this one, will be added to the loanable amount. How much was the loanable amount at first?
1,020 kwacha.
1,020 kwacha. This is what it means. So this amount is excess reserve. Being excess reserve, it shall not be kept. The bank would not want to keep excess of the reserves. So even those other reserves, they will have to, because the assumption is that this 1,020, it is not given to someone in hands. It's a deposit. Like when the bank is giving this loan to someone, they deposit it in their account. So it's a deposit. You get? So they deposit in this person's account. It's a new deposit. So it will have, again, another reserve. Now those reserves, again, shall be added to the same amount, because it's part of the loanable amount. You get it?
Okay. Yeah, I get it.
All right.
It will go to the reserve.
Yes, yes. So the excess reserves, you get it and add it again to the loanable amount, because the bank does not keep excess reserve.
No.
They just keep initial reserve. They require the reserve.
When you say it will be added to not to the reserve, to 180.
Okay. Okay. Let me draw the more like a T account. Okay. Get this. You make an initial deposit of 1,200, right? At first. Then our reserve was how much? Was 180, isn't it?
Yes.
180, and the 1,020 was what? Was the loanable amount. So now this 1,020, the loanable amount, shall be what? Shall be deposited again, right? You're going to deposit it into the account of that person you have given a loan.
Okay.
You're following? When you deposit this amount to this person whom you gave the amount, The 15%, you get the 15%. What's the 15% of this?
153.
It's 153. This 153 was supposed to be added here on the reserves as the 180 plus the 153. So then the reserves are just supposed to be 180. That is the required level of reserve from the initial deposit.
It's constant.
You get it, right? It's supposed to be like that, just that. So when you add the other 153, it means that you have excess reserve. You get the reserves that you have are more than the required. So this amount again, you have to add it again to the what? To the deposit to be part of the loanable, amount.
Okay.
Did you get it now?
Yeah.
Okay. Now define the fiscal policy. What is the fiscal policy?
So fiscal policy, it's that's when the government actually deals with tax and unemployment. So those are the two components of fiscal policy, and it's one of the two that the government uses to control the economy. So when the government increases the taxes, it means actually taxes are leakages. What am I saying? Okay, let me give chance to others first.
Okay. Right. Let's define a fiscal policy. What is a fiscal policy? What did we say a fiscal policy is?
Ana Clara. So Ana Clara waliomo.
Valimo.
Hello?
Let's participate.
Vanava Jesu, exams are next month. Vanava Jesu, answer the question.
So let me try to explain. But fiscal policy is one of the two the government uses to control the economy, and it has got two components: unemployment and and taxes.
Okay. All right. Thank you so much for the attempt. All right. So the fiscal policy, we defined it as just the policy, the government policy on the tax mobilization or revenue mobilization and the expenditure. Just that. So it is the policy that guides the government on how to mobilize the resources. That is called the revenue mobilization, usually through taxes and government expenditure on how they are going to spend this same amount in what is called government expenditure. So the main components of the fiscal policy is the government expenditure and the taxes. Yes. So, so now explain two instruments of fiscal policy. The hint is of also use those two instruments to explain the expansionary and the contractionary fiscal policy. Be clear in your explanation. That's what the question says. But don't worry about being clear in the meantime. Just explain. But you should be clear next month. Yeah. Hello.
So the two instruments is, like you have said, it's on tax and government spending. So when we want to explain on expansionary, it means the government now wants the economy to expand. So it is going to use the government spending. The government is going to spend, which means there will be more investment, and the economy will increase. So on the contractionary fiscal policy, this is where the government now will use taxes, will increase the taxes. So also on the expansionary, the government can reduce the taxes so that there will be more money and the economy will boom. So on the contractionary now, this is where now the government want to control the economy by restricting restricting the money by increasing the taxes.
Okay. Okay. Thank you. Thank you so much. Did I hear you mentioning about investments, that the investments will increase?
Yes.
Oh, okay. Okay. Interesting.
So
The investment.
Where you odd investment plus is it what can I say is it when you odd the investment to increase.
Okay. Now check. Investments are an exogenous model. It's an exogenous variable. It's not really an endogenous variable per se. So it's usually autonomous. It's fixed. Okay. In the meantime, or if you want to make it vary a bit, it can just be influenced by interest rates. So here, since we are not talking about the interest rates, investments will not be affected. Investments can only be affected by the interest rates, not by the change of the government expenditure or taxes. So you don't talk about it. You got it?
Okay.
Yeah, don't mention the investments. So just talk about the level of output, because
for that formula.
look, Y is equal to this autonomous expenditure plus the marginal propensity to consume, Y minus taxes, plus the investments plus G. You get? So what is happening is that when you adjust the taxes, for example, you reduce the taxes, you increase the G. What will just increase is the Y. But this one being an independent variable, I will not change because you have changed this. Have you observed that? Okay. If you follow the equation, so the investments will not be affected by the fiscal policy. So you don't mention the investments. Instead, you can mention the level of output is the one that is affected by the fiscal policy. Clear?
Clear. Maybe you can explain about the autonomous and the other. I think that there are two components there.
Okay. So just maybe to add on what has already been said about the fiscal policy. So there are two components, being the government expenditure and taxes. Let's start from expansionary fiscal policy. So with expansionary fiscal policy to start with, we use it when the economy is in the recession. We want to lift the economy out of the recession. So what we do is that you increase government expenditure, you reduce taxes. I've already shown in this equation that there is this autonomous consumption plus the marginal propensity to consume, Y minus taxes plus I plus G. So if you increase this G and you reduce this tax, then this Y variable, the level of output, will increase. That is what the expansionary fiscal policy is all about. Then the restrictive fiscal policy is when you do the opposite. That's when you reduce government expenditure and increase the taxes, right? You increase the taxes and reduce government expenditure. The impact shall be reflected in the equation. Marginal propensity be Y minus taxes plus I plus G. Assuming that we are dealing with a closed economy with the government, this is the assumption we are dealing with. We don't have the external world participating. So if you increase taxes, and reduce G, what will happen to the Y? The level of output will reduce. This is the idea behind restrictive monetary policy. The restrictive is also called the contractionary fiscal policy, not monetary, sorry, the fiscal policy. Is that clear?
Yes, sir.
Okay. It is well. Explain the difference between progressive and regressive taxes. We did a little bit of taxation. What could be the differences between the two taxes, the progressive and retrogressive tax? What is progressive tax?
Clara.
Hello? Clara, you are being called. People are calling. You have slept. But how are you? All right.
I'm fine, sir.
You're fine. People are calling you.
I don't know why they are calling me. Some of them get through.
All right, it's an interesting conversation. What is progressive tax? Or what is progressive
Maybe
one?
try
Let's start with, yes.
I think a progressive tax is a tax system where the tax rate, it increases as the taxable amount increases also. This means that when an individual has got higher income, then he pays a larger percentage of the income in taxes than those that have got lower taxes, lower income, sorry.
Okay, what about regressive taxes?
What regressive?
Yes.
Regressive, I think regressive is a tax system where the tax rate decreases as the taxable amount increases. So
Okay.
this is whereby maybe an individual has got lower income, then is paying a larger percentage of their income in taxes than those with higher incomes.
That is regressive?
Yes, sir.
Or that is progressive?
No, it's regressive. The
Okay.
progressive.
Thank you very much for. Okay. Okay. Yeah, thank you very much. So for progressive tax, from the way the progress, this tax, the tax rate will increase as the income bracket does change. So as the taxable amount keeps on increasing, even the rate does increase. I think you, so you see that the people Maybe the people who earn between this range up to this, they pay this much. You get it, right? Then though you earn from this amount to that amount, they'll be paying this rate. So usually the more the money you earn, the more the tax you pay. That is for progressive. Okay. And then retrogressive is the opposite. As the more money you have, then the difference, the lower the amount that you pay. So if the taxable amount is higher, then the rate does go down. Usually we don't use the regressive tax for individuals. Usually they use it for corporations. For corporations and for what's this? Yeah, for companies, for entities. That's why you can have such usually applying. So in Zambia, it's like you use the progressive, right? Is it progressive that you follow? Or which one do you follow? Is it taxation you? Which tax system do you follow in Zambia?
I think it's progressive.
Okay. This is very, very important to get to know. You see that the more money you make, the more offering you take to the big brother, the government. Any question?
So it can happen in an individual. The more
It can
money that
happen.
you get, the more money you pay to the government.
Yeah. Yeah.
The rest you get, the rest you pay to the government.
Yeah. That's for progressive, isn't it?
What did you say
All
on
right.
regressive comparing to an individual? Regressive.
I commented that for regressive, usually the opposite. Like the more money you have, then the more money income you have, then the less the tax you pay, you get. There is that tax system where like the huge sums of money, like for huge corporates, they don't pay a lot of tax as compared to these individuals. Like where you are paying more money as the time as you increase, like you charge the opposite, you get.
Oh, it's like they look at what you have invested and the influence that you are affecting the economy.
Exactly. So you find that those who have invested a lot, like they're really doing a much contribution to the economy, they don't pay a lot of tax. The tax rates are low as compared to these that have not done much. You get, there are such levels of taxation.
Yeah,
You get.
I get it. Can give an example. Let's say Zambia, which has employed thousands of people. So those instead of it paying more tax, the people who work to Zambia will pay taxes to the government.
Exactly, they pay more tax through progressive tax. Yeah. Okay.
So
it's good that
there's that tax on the pay slip, like if you've just been employed, let's say you haven't been paid for 3 or 4 months, they deduct a big amount.
Sorry, you can come again.
I'm saying there's that tax that they deduct, like when you are just employed, then you haven't been paid like for 3 months. There's that tax that they will deduct. The amount is very big. Let's say you're getting 5, and then if you are calculating for 3 months, I haven't been paid, I'll get a 15. Then to your surprise, you find maybe you just have 11,000. So that can also be called progressive tax.
It's a good question coming to the class. What does the class think? What does the class know? You have heard the question, right? Did the class get the question?
Not clear.
Yes. So what is the explanation?
It's not clear. Maybe you can, if you can.
Yeah, she was
explain more.
breaking. I didn't get clear. Maybe come again, madam. I was hardly getting her.
Oh, no. What
I
I
was
thought.
saying, yes, I was saying, if you're just employed, like you just get employed, and maybe you're expecting a salary of 5,000 per month, and you haven't been paid, let's say, for 3 months, and then let's say you're even employed by the government, for example, and then it's going to deduct tax. Let's say you're expecting a 15,000 for 3 months, and then your pay, you just find that it's 11,000. The 4,000 has gone to tax. I was asking, is that also part of, is it progressive taxing?
Okay. I get it.
Well, that's
I
simple.
get the question. Someone wants to attempt it?
Yeah, that's simple. So, actually, you have said that you have not been paid for the past 3 months. So, just need to add those taxes per month times 3. Then they'll deduct at once.
Yeah. So you get I get the question again. Yeah.